Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We certainly have one today.
Today, we're breaking down a company that is, well, an absolute giant in global medical technology. It's a company that provides the foundational, the literal plumbing of healthcare systems worldwide.
A name most people have heard of, but very few really understand the, let's say, the financial complexity under the hood right now.
We are wrestling with Baxter International, ticker BAX. Now, on the surface, this is an indispensable business. They sell IV solutions, infusion pumps, premixed injectables. These are products that are non-cyclical, life-sustaining, just must-haves.
You can't run a hospital without them.
Exactly. But here is the central question for us as long-term investors. How can a business with such an essential, durable moat be struggling so profoundly with, debt, integration disasters, and quality control issues?
That is the entire premise of today's analysis. We need to separate the temporary, the fixable headaches, the legacy of some bad M&A and operational missteps, from the risks of a permanent structural deterioration of the business.
So is this an essential fortress that's just on sale due to temporary problems, or is it genuinely a financial quicksand trap?
A trap built on a sinking foundation of eroded trust. That's what we're here to find out.
That's a massive question, Brian. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel.
And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model.
And to really understand the current financial picture, we have to start with the huge structural changes that are happening right now.
Yes, absolutely. We can't analyze the company that existed 2 years ago. We have to look at what it's becoming.
Right. We're looking at a Baxter that's in the middle of a major transformation. The analysis of the past is interesting for context, but the investment thesis today has to focus on the leaner core that's left over.
Exactly. The core structural moves are absolutely critical. They have huge implications for the balance sheet and the future growth profile.
So first, they successfully divested the Biopharma Solutions segment.
Right. They sold off a non-core specialized manufacturing unit. There was a very clear move to raise cash and, to simplify the business.
And then there's the really big one. They're spinning off the specialized kidney care business,
which they've branded Vantive. That's slated for early 2025. And you're right, this is monumental. It dramatically changes the entire complexion of the remaining company.
So what does the post-Vantive Baxter look like?
Post-Vantive, the core Baxter business focuses almost entirely on the acute care and hospital consumables segments. The goal, and management has been very clear about this, is simplification.
So concentrate capital on the higher growth acute segments
and above all else, aggressive deleveraging. So our conversation today, it really centers on the quality and durability of this remaining leaner business.
Okay, let's unpack this core business model first. When we look at the remaining Baxter, the essence is almost, I'd say, beautifully simple. And that simplicity, it often translates into financial endurance.
Yeah, we often use the mental model of Tollbridge economics.
It's the perfect description. A Tollbridge doesn't care if the economy is great. It just depends on people needing to get from point A to point B.
And in medtech, this means the company makes money simply because essential patient traffic must pass through its domain. Revenue comes from high-volume, recurring sales of consumables.
Things like IV bags, specialized tubing, drug delivery systems.
Exactly. Things that are consumed daily, often multiple times per patient in massive quantities.
Whether they are in a hospital bed, an operating room, or even a home care setting.
So this is, in its purest form, an annuity-like revenue stream. The key here isn't the price of one item, it's the sheer volume and the recurrence.
And that gives them a specific kind of pricing power that we really need to break down.
Well, they're selling mission-critical commodities. The cost of the item itself, an IV bag, say, is tiny compared to the overall cost of a day in the hospital.
But the cost of not having it.
It's infinite. You can't provide care. That's where the power lies.
So even though they're dealing with huge hospital systems and group purchasing organizations, Baxter still maintains leverage because these products are just not discretionary.
Demand isn't driven by quarterly GDP or, even government budgets in the short term. It's driven by the fundamental non-cyclical human need for life-saving medical care.
And this enduring microeconomic model is it's heavily bolstered by some really powerful secular tailwinds.
Which is crucial when you're projecting long-term growth. You need a rising tide.
And you have to zoom out here and look at the unstoppable forces driving demand. The most obvious one is the rapidly aging global population.
And this isn't just a U.S. thing or a Europe thing. It's happening worldwide.
As populations age, the prevalence of chronic diseases, things like cardiovascular issues, diabetes, and especially kidney failure, it just skyrockets.
And these conditions require continuous intervention, often involving fluid management and specialized medical supplies.
Which is Baxter's bread and butter.
Exactly. And on top of that, we're seeing a really significant structural shift toward home-based care models.
That's a huge trend, driven by cost pressures, patient preference.
And just new technology that makes it possible. Hospitals are trying to push any care that's not acutely critical out of that expensive institutional setting.
So what does that mean for Baxter? It means specialized devices and supplies. Things like smaller, smarter infusion systems or portable dialysis systems have to be delivered directly to the patient's home.
Right. And Baxter is exceptionally well-positioned to supply this whole suite of necessary home care equipment. It opens up a whole new, higher-growth revenue channel that really wasn't a big deal even 5 or 10 years ago.
So these macro forces provide a continuous lift, making the underlying demand fundamentally robust.
Okay, so we have a durable business model. It's supported by these big macro tailwinds. What protects it from competition?
The moat, the competitive fortress.
And that moat is overwhelmingly based on high switching costs. It's reinforced by their intangible assets, especially regulatory know-how and deep institutional trust. Or at least what should be deep institutional trust.
Yeah, we'll get to that. But the key is understanding the massive operational friction that those switching costs create. This isn't like switching your cell phone provider.
Not at all. Let's use a really concrete example.
Hey.
They're Novum IQ infusion pumps. These pumps are, for all intents and purposes, the center of a hospital's drug delivery universe.
So if a hospital is using the Novum IQ system, they're not just buying a piece of hardware.
No, they have deeply integrated this platform into their entire operational infrastructure. This means immense, non-recoverable sunk costs. Think about just the staff training.
Thousands of nurses, pharmacists, technicians, all trained on this specific interface, this specific dosing mechanism, these specific error messages.
That expertise is perishable. If they switch platforms, you have to retrain everyone.
But the real friction, the part that makes it almost impossible to switch, is the technology stack. It's the electronic medical record, the EMR interface.
It's not just plugging the pump into the wall. The EMR system is customized to talk to that specific pump. It has to ensure the right drug libraries are loaded, to integrate with barcode scanners for patient safety.
And to record precise flow data right into the patient's chart.
Any change in that interface that's compliant with regulations requires rewriting EMR code, extensive testing, and regulatory validation to prove the new system is safe.
That process can take years and cost hundreds of thousands, if not millions of dollars just in IT work.
So switching to a competitor, let's say Braun, it's not a procurement decision. It's a total IT overhaul, a massive retraining program. And critically, you're managing the risk of a catastrophic operational error during the transition.
The sheer inertia built into hospital protocols is the ultimate competitive moat. It's stable simply because it's terrifying to change.
But that stability is not absolute. We've seen cracks.
Right. The stability of that moat is totally dependent on the continuation of that intangible asset. Institutional trust.
And this is exactly where the operational reality has slammed right into the investment thesis. The moat is stable because of inertia, sure, but it gets actively eroded by internal quality control failures.
When the product is essential, reliability is the moat.
We saw a glaring example of this with the voluntary hold they placed on Novum IQ LVP shipments in 2025.
That's the large volume pump.
Right. And the hold was due to concerns over flow rate accuracy issues. Now, a flow rate issue in an infusion pump is not a minor glitch. It's a direct threat to patient safety. It's a threat to the very definition of reliability.
So when that happens, the hospital customer is put in an impossible position.
They are completely dependent on the installed base of pumps they already have. But now they're suddenly dealing with significant operational risk and administrative headaches.
that directly challenges the must-be-reliable promise that keeps those switching costs so high in the first place.
And if these failures keep happening, the hospital's leadership is forced to ask a very tough question. Is the cost and risk of staying with Baxter now greater than the cost and risk of switching?
And that is how the moat starts to crumble, slowly but maybe permanently if that quality control isn't fixed.
Stepping back a bit, how does Baxter position itself within the broader medtech world? There's a critical distinction to be made here.
Yeah, the analogy we like is that Baxter is the foundational plumbing of the hospital. It enables everything. A lot of their competitors, they focus on the specialized high-margin fixtures.
That analogy perfectly captures their niche. Baxter plays in mission-critical consumables and the core delivery systems. When you look at their rivals, the competitive differentiation is pretty stark.
So first, you have Braun.
They are the direct head-to-head rival in infusion therapy and certain surgical disposables. They often get aggressive, positioning themselves as a high-quality, sometimes lower-cost alternative to Baxter's ecosystem.
But Baxter's durable advantage has always been its scale and its installed base. They have a dominant history in essential IV solutions and the whole connected ecosystem of pumps.
So Braun can compete aggressively on price for a new hospital contract, sure. But dislodging a fully integrated Baxter system from an entire health network, that's a decade-long battle because of all those switching costs we just detailed.
Then you have the giants like Medtronic.
Medtronic is a massive, innovative force, but their focus is largely elsewhere. They're in higher-margin, cutting-edge devices, implantables, advanced monitoring. They're focused on the future of treatment.
Right, and Baxter's essential consumables are required regardless of which high-tech implant Medtronic is putting in a patient. Their businesses are more complementary than they are competitive in that core hospital space.
And finally, post-Vantive. The relationship with Fresenius Medical Care, or FMS, gets a lot clearer. FMS dominates dialysis services and clinic operations.
So by spinning off Vantive, the core remaining Baxter business gets to focus more squarely on the general acute care setting, which minimizes that direct rivalry in dialysis.
It lets FMS be the dominant service provider in that specific market, and Baxter gets leaner and more focused on the hospital infrastructure.
Okay, so to round out our view of this fortress, we need to talk about sentiment, the scuttlebutt from the ground. How do customers and employees feel?
Well, for the customer, Baxter products are essential commodities. They have to be reliable, but they're not sources of joy or innovation.
They're the utility provider of the hospital. You don't call the power company to tell them they're doing a great job.
You only call them when the power goes out. And that's exactly why the sentiment has been so negative lately. When something as crucial as the Novum IQ pump starts creating operational headaches and regulatory holds, the frustration just multiplies exponentially through the whole hospital system.
It's not just an inconvenience. It translates into wasted staff time and potential regulatory scrutiny for the hospital itself. The narrative shifts from trusted essential provider to source of operational risk.
That is the invisible internal damage that feeds the entire bear case.
And what about internally? The employee view.
It's critical. There's genuine pride in the mission, save and sustain lives, and that provides a cultural anchor. But that's offset by significant internal turmoil. Reports indicate high turnover in key operational and technical areas, which is often a symptom of underlying cultural issues.
And crucially, there are ongoing integration challenges from that massive debt-fueled Hillrom acquisition in 2021.
Integrating two enormous, complex, and distinct corporate cultures and IT systems takes years, and it creates the bureaucracy and the slowness that, ironically, prevents a rapid response to those very quality control issues we were just talking about.
So the employee sentiment confirms this dual nature of the problem. A noble mission and an indispensable product, but a slow, bureaucratic execution machine that's currently struggling under the weight of its own strategic debt and M&A indigestion.
Which brings us perfectly to Section 2, Management Stewardship. Because the business with an indispensable moat can still be ruined by poor decisions at the top.
We have to examine CEO Jose Almeida's tenure. He started in 2015, and we have to focus on capital allocation.
Almeida's stated strategy has been pretty consistent. Portfolio simplification and operational excellence. The goal was to create a leaner, higher growth core.
Conceptually, that's exactly what the company needed.
But the implementation involved a monumental, and I mean monumentally costly, misstep, that 2021 Hillrom acquisition.
That deal was enormous. It was a $12.5 billion debt-financed acquisition aimed at accelerating Baxter's move into connected care smart beds, patient monitoring, digital systems.
The idea was sound,
Oh,
merge the essential plumbing with the smart fixtures.
but the execution was disastrous from a balance sheet perspective. It became the single major source of the company's crushing debt load and just an enormous operational distraction.
It completely overshadowed all the simplification goals Almeida had initially championed. The data is very clear on this. The acquisition failed to meet its initial financial promise and became a heavy anchor.
The market hated the valuation they paid, and the debt load was immediately seen as excessive for a medtech company known for stable but, moderate growth.
However, what we're seeing now is a very decisive, painful, but rational course correction.
The biopharma divestiture and the upcoming Vantive spinoff, that's management's attempt to triage the financial damage.
They're aggressively selling non-core assets to focus capital, and most importantly, to urgently reduce that leverage that was created by Hillrom.
Nothing speaks louder about management's priorities than their willingness to sacrifice popular shareholder mechanisms.
And here we have a critical, very painful signal. The stated intent to drastically reduce the quarterly dividend starting in early 2026.
That is a financially rational move that will immediately alienate a huge chunk of their traditional income-focused shareholder base.
But given the net debt to EBITDA ratio, this is the height of prudence. Management is explicitly prioritizing debt reduction and balance sheet integrity over immediate returns for shareholders.
So the board is effectively telling the market, look, we made a mistake on M&A, the debt is too high, we're pulling every single lever, including stripping down shareholder returns, to fix the balance sheet because solvency and stability have to come first.
And this leads to a really interesting challenge question. If they're truly prioritizing debt reduction now, shouldn't they have cut the dividend before taking on all that Hillrom debt?
That's the key question, right? It separates poor past allocation from rational current action. The past decision to lever up and keep the dividend suggests, frankly, overconfidence or just poor foresight about the Hillrom integration challenges.
But the current decision is an acknowledgement of reality. It's damage control. The cut signals that management finally recognizes the severity of the leverage and is willing to endure short-term pain for long-term recovery.
And we can see alignment in their incentive structure. Management's PSUs, their performance share units, are tied to metrics like adjusted return on invested capital or ROIC and adjusted EPS.
So they are incentivized to generate higher quality earnings and efficient capital usage, not just, top-line growth. They have a vested, measurable interest in making this turnaround work.
Okay, let's talk about the numbers because this is where Baxter gets incredibly confusing for a lot of people. If you look purely at GAAP profitability, generally accepted accounting principles, it looks like a chaotic, failing business.
Yeah, the GAAP numbers are volatile and inconsistent, and it's because of these massive non-cash special charges that are all tied to the M&A cleanup.
We're seeing substantial intangible asset amortization and critically huge impairment charges.
These are write-downs on the goodwill and assets specifically related to the Hillrom or frontline care segment.
And these non-cash write-offs are essentially the company acknowledging that the price they paid for Hillrom was too high and the assets are worth less than what they're carrying them for on the books.
And these charges absolutely crush the reported GAAP earnings. It makes it look like the core business is failing, when in reality, it's just processing this massive hangover from the M&A deal.
And all the while, the core business growth is, it's frustratingly weak. It's stuck in the low single digits.
To put the magnitude of this in perspective, these Hillrom-related impairment charges can often wipe out the equivalent of multiple quarters of core net income on paper.
Which is why the reported GAAP TTM, ROIC, the return on invested capital, has been near zero or sometimes negative.
That ROIC figure is the clearest possible scorecard. It tells you the capital invested in the Hillrom deal has not met the cost of capital, and it has undeniably damaged the company's quantitative quality narrative.
So the ROIC is screaming, bad capital deployment, but this is where we find the hidden quality. The crucial insight is free cash flow conversion.
This is the silver lining that the whole bull case hinges on. Despite all that GAAP noise, the core underlying business is structurally high quality from a cash perspective.
It exhibits strong underlying operating cash flow and robust free cash flow conversion. For 2024, the FCF was approximated at about $373 million?
Around there, yes.
So why is the free cash flow so robust despite the weak growth and the terrible GAAP earnings?
There are a few structural reasons that are kind of specific to this kind of medtech business. First, high depreciation and amortization. Because Baxter owns this massive installed base of equipment and infrastructure, their D&A is high, and that shields cash flow from taxes even when GAAP earnings are low.
And second,
Stable working capital requirements. In the consumable space, inventory management and accounts receivable that tend to be pretty predictable, so they don't require large, unexpected cash injections just to keep the lights on. The cash earnings power is just very durable.
so the paper losses are loud, but the cash register is still ringing.
Exactly. This robust underlying cash generation ability, the conversion of accounting earnings into real cash, is the key indicator of a durable earnings power that's just being masked by non-cash charges related to past mistakes.
However, we have to address the 800-pound gorilla in the room.
The debt hurdle.
The net debt is highly elevated, all driven by Hillrom. The net debt to EBITDA ratio is at a level that is definitely concerning to credit rating agencies.
This high leverage is the single biggest risk today, bar none. It limits their flexibility, it increases their interest expenses, and it threatens their credit rating.
But the crucial point is the strategy to deal with it.
Right. Management has an explicit, prudent, and pretty detailed plan to address this. Their target is to drive that net debt to EBITDA ratio below 3.75 times by the end of 2026.
And this isn't just wishful thinking. They're executing it through 3 clear levers.
1, asset sales, the proceeds from biopharma and Vantive. 2, strong FCF generation from the core business we just talked about. And 3, that dividend cut.
The viability of this entire turnaround story relies on them executing this deleveraging plan on time. If they fail to hit that 3.75x target,
the interest burden becomes permanent and crippling. It would threaten future R&D spending. But if they succeed, the market will almost certainly re-rate the business upwards.
Okay, that brings us to section 3. Let's shift to the market's perspective. How is the street pricing this highly complex, leveraged situation?
This is the definition of a valuation dislocation. Historically, a company with Baxter's structural moat and stability would command a premium, a compounding multiple.
But today, the stock is trading like a low-quality, highly leveraged value or turnaround play.
We're seeing a forward PE ratio sitting around 8.07x. For an essential medtech supplier, that is dramatically low.
The market is screaming skepticism.
The market is fully discounting all of the difficulties. They're pricing in the operational instability, the overhang from the Novum pump issues, the ongoing profitability hit from the non-cash impairment charges, and that high debt load.
So the current valuation treats Baxter as a highly risky problem child, not a stable infrastructure provider.
And that dislocation is what creates the margin of safety if the turnaround succeeds.
So if an investor is looking at Baxter today, how do they obtain a sufficient margin of safety? It can't just be based on the low PE alone because cheap stocks often just get cheaper.
There are 2 specific pathways to securing that margin of safety, and they relate directly to the operational and financial risks we've been outlining.
The first one relates to the operational setbacks.
Correct. The first is buying after the market has fully processed the reputational and financial fallout from the quality control issues.
So buying when the news is unequivocally bad.
Exactly. Buying after the market has discounted the temporary but severe impact of, for example, the Novum pump hold. This is a bet that the operational lapse is temporary.
And the second pathway?
It involves patience and waiting for the balance sheet to be de-risked. This is the more prudent path.
So it means buying only after the balance sheet is substantially healthier.
Right. We talked about their target of 3.75x net debt to EBITDA by 2026. A truly conservative investor might wait until that ratio is below 3.0x, which would signal that the company has sufficient financial breathing room.
That avoids the permanent impairment risk that comes from a high-interest debt burden.
This is a classic case study where the entry price, combined with patience for that deleveraging to happen, is the ultimate determinant of long-term success.
So, assuming management stabilizes the operation and hits those deleveraging targets, where does future growth come from? What are the specific engines that have to offset the current weakness in the core?
We need to see significant acceleration in 3 key areas. First, the expansion of their pharmaceutical segment.
This is the pre-mixed injectables, ready-to-use pharmaceuticals, compounding services.
Exactly. These are higher growth areas because they improve safety and reduce preparation time in the hospital pharmacy. They're solving a labor and efficiency problem for their customers.
So it's a compelling trade-off. Higher costs for the drug itself, but massively reduced labor cost and error risk for the hospital. That's a value proposition that can support higher margins and faster growth than, say, standard Py-V saline bags.
Second, they have to justify the entire Hillrom acquisition. That means successful integration and market penetration of the connected care products.
They need to prove that merging smart beds, patient monitoring, and their infusion pumps actually creates a superior integrated ecosystem that was worth all the debt they took on.
Right. This is about capturing value from the operating room and the patient room integration that the old Baxter just didn't have.
And if they can deliver true seamless integration where the smart bed talks directly to the infusion pump and the EMR, that creates a whole new layer of switching cost and a new revenue stream that someone like Braun just can't match.
And the third driver is simply operational stability returning to the core infusion business.
They have to resolve the quality issues, get the regulatory holes lifted, and successfully regain market share and trust in their core therapies.
If they can't stabilize the base, the growth engines won't matter.
Okay, we have to spend time detailing the bear case. This is how a temporary setback spirals into a permanent loss of capital for investors. What are the specific risks of permanent impairment?
The most dangerous risk is the sustained catastrophic loss of trust, the erosion of that intangible asset. If those quality control failures, the Novum IQ issue or new ones, become a recurring pattern.
That leads to two outcomes: permanent customer defections and potentially devastating regulatory action like a consent decree from the FDA.
Right. If a big hospital system decides Baxter is just too risky, they will dedicate the resources to switch. And once that installed base is gone, the moat is gone with it, forever. This threat is existential because reliability is their core product.
What's the second major risk?
The debt overhang failure. If the deleveraging plan fails, if asset sales stall, or the Vantive spin is delayed, or if FCF weakens, they're left with a continued, crushing debt burden and high interest payments.
So the business gets starved of capital.
Exactly. That debt service prevents necessary R&D investment in new products or, critically, in fixing the operational quality systems. Competitors like Braun would permanently widen the technology and reliability gap, and Baxter would be stuck just servicing debt instead of investing in its future.
And the third risk?
Outright commoditization in the traditional consumable space. Aggressive competition, especially in generic IV solutions and non-smart pumps, could permanently pressure their gross margins.
And if margins degrade significantly, the sheer cost of maintaining their massive manufacturing and distribution infrastructure becomes prohibitive. The installed base moat becomes economically useless because they can't charge enough to cover their high fixed costs.
Given those potentially lethal risks, why would a contrarian investor even look at Baxter right now? The market consensus, driven by that low valuation, is that this is a messy, leveraged value trap.
The contrarian view relies on second-level thinking. They would argue that the market is over-discounting the durability and the essential non-negotiable nature of the core products.
So the setbacks are seen as severe, yes, but they're viewed as temporary executive errors in capital allocation, not structural flaws in the underlying market itself.
A bullish investor would see the dividend cut and the asset sales as painful but ultimately rational steps that position the business for decades of stable, cash flow-driven compounding.
They're betting that the management team, having made the mistake, is now capable of cleaning it up effectively.
And that powerful underlying FCF conversion ability is the hidden factor.
It's the turbocharger. If operational stability returns, that FCF will rapidly clean up the debt faster than the market expects, leading to a massive re-rating of the equity multiple as the financial risk disappears.
The sheer essential nature of the business acts as a powerful safety net against total failure.
So for those adopting that contrarian thesis, what are the milestones, the key catalysts that would signal the thesis is playing out correctly? What should you be watching for?
The first and most immediate is a clear resolution to the operational quality issues.
We need a final regulatory sign-off and the removal of the voluntary hold on the Novum IQ infusion pump system. That signal a return to operational stability in a key, visible segment would remove a massive overhang and begin the process of rebuilding customer trust.
If that hold gets lifted, it suggests the internal bureaucracy has been overcome and capital is being effectively deployed to quality control, which addresses that cultural rot we talked about.
The second catalyst is entirely financial, achieving those debt reduction milestones ahead of schedule. We need to see the net debt to EBITDA ratio convincingly drop, maybe getting below 3.75x or even 3.5x sooner than their late 2026 guidance.
And that achievement, driven by strong FCF and clean asset sales, would trigger a necessary credit rating upgrade.
And most importantly, that credit rating upgrade triggers a market re-rating of the stock. It shifts the narrative from high-risk turnaround with an 8x multiple to de-risked compounding machine with a potentially 12x or 15x multiple.
which would deliver exponential returns from this low base. The execution of the Vantive spinoff also has to be clean and efficient, maximizing value for Baxter shareholders.
This has been an incredibly complex and detailed deep dive into a company that is truly at an inflection point.
To synthesize what we've discussed, Baxter International possesses an indispensable essential moat. It is the functional plumbing of the global hospital system, but that core stability has been dramatically challenged by poor capital allocation in the form of the Hillrom debt and compounded by internal operational missteps and quality issues.
The entire investment proposition hinges entirely on execution. Does the undeniable core product durability and powerful FCF conversion ability ultimately overcome the systemic drag of the past few years?
Or is this just the first stage of a long, slow decline exacerbated by competitive pressure and debt?
And that leads us to our final provocative thought for you to consider, the red team challenge we always like to pose.
Here is the ultimate question to invert the bull case. Management is rationally deserting all available cash from asset sales, FCF, and the dividend cut to debt reduction. But what if those visible quality failures, like the Novum IQ issue, are not just isolated incidents?
What if they're symptoms of deep systemic cultural rot and sustained underinvestment in the operating infrastructure?
So if management is so laser-focused on deleveraging the balance sheet that they divert the necessary capital needed to fix these deep-seated operational quality and R&D issues,
Does that financial prioritization risk permanently destroying the intangible asset of trust that the entire moat is built on?
if they fail to invest in quality because they are fixated purely on the debt ratio, you could face permanent impairment regardless of how cheaply you buy the stock today.
That is the long-term risk to measure against the short-term deleveraging success.
Food for thought indeed. Thank you for joining us for this extensive deep dive into medtech infrastructure and high-stakes turnaround strategy.
We hope this analysis helps you navigate this complex financial landscape and inform your own decision-making. We'll see you next time on Synaptic Investing.